This episode of The Benefit Whisperer is brought to you by Route 3 Insurance and Financial Services, where smarter benefits begin. If you're tired of rising healthcare costs and opaque insurance contracts, Route 3 is here to help you take control. They specialize in transparent, employer-driven benefit strategies that protect your people and your bottom line. Ready to break away from the status quo? Visit www.fixmybenefitsnow.com and discover how Route 3 can help you build a plan that actually works for your team and for your budget. Hello and welcome to The Benefit Whisperer, the show where we pull back the curtain on what's really driving your healthcare costs and how you can stop feeding a system that's rigged against you. I'm Ralph Weber, and today we're talking about something every employer, consultant, and broker needs to understand if they're serious about escaping the status quo, the BPO hamster wheel, etc. And that is captives. We hear a lot about captives. It's different than capitation. Maybe we'll talk about that today too, Phil. What they are, how they work, and why more straightforward thinking employers are using them to break free of the traditional insurance straps. So on our last episode with Phil, we had a lot of really good information. So if you're just starting at this one, make sure you listen to the other episode as well. So, again, caution, there are good captives and bad captives. Every employer, every situation is different. So don't just use a captive and think you're solving the problem. And again, on the last episode, we talk about that. So I'm joined again today by Phil Holowka, Chief Operating Officer at Complete Captive Management Services. With over 20 years of experience in finance and risk strategy, Phil helps employers take control of their healthcare spend by designing and managing captives that actually work for their business, not for the carrier. Phil, thanks again for being here. Good to see you again. Can you tell the listeners, you told a lot about yourself last time, which was great. Just a little bit more of your background and how you fit into the captive space.
Yeah, sure. So I am a captive manager, and my daily job is to really run the back office of the various captives that we have under management. And in large part, captive management services is an accounting function. So I deal with premium remittances, financial statements, paying claims, everything that a normal insurance company deals with. So that is my day to day, and I have a fantastic staff that does all that for me. So not me doing that, but nonetheless, the captive management company is something that I'm very, very passionate about. And it was my second profession of my career. As I mentioned earlier, I was a paramedic for 20 some years, and it was a very exciting career choice for me.
Well, your first time you meet with an employer about captives, do you ever have to take out the paddles and kind of shock them a little bit?
Sometimes to get their attention. I would love to do that. Yes.
Great having you on again. I was just so captivated by our last conversation that I just thought you have a lot more to share. So let's have another episode. Let's dive in and pull back the covers. So
sounds good.
Let's start with a success story. Can you share a success story of an employer or an association that made the move into a captive and saw measurable improvement in cost control or care quality?
Yeah, I think every story that every one of our clients has a success story that is near and dear to their hearts. We have members that have been with us for day one, 15 years.
Wow.
Okay. So their success story may be different than a first or a second year member, but the success really is something that is, whatever that employer is looking for, the captive can help achieve it by way of making them smarter. That's it. And when you become a smarter buyer, you can reap the benefits of that. Now, the benefits could look differently. It could look like underwriting profits. So in other words, you once were paying for something, getting an expense, and you had nothing to show for it. Tomorrow with a captive, you could be expensing your stop loss premiums while at the same time you're picking up an asset. So success can be very different to very different people. But I will tell you this with 100% certainty. If you give me 4 or 5 years, I will give you $100,000 plus.
Wow.
Just like that. So it's money that is lost to the system. And when you pay yourself, you are the beneficiary of those payments by way of underwriting profits.
Wow. So it sounds kind of like you're saying renting versus leasing or
Yep.
owning a home versus renting a home. Is that a fair analogy?
Yeah. So you're getting an asset, right?
Hmm.
So when you buy insurance, that is a business expense. You're deducting that. That's a good thing, right? You get to
Hmm.
deduct that from your profits. But when you own a single parent captive, not a group, a
Right.
single parent captive, GAAP requires you to consolidate the financial statements. So,
Okay.
Ralph, this is literally taking $20 from your left pocket and putting it into your right pocket. You still control the $20 and you
Right.
still report that on your balance sheet.
Yep.
So it's remarkably more advantageous to do a single parent captive where you own 100% than a group captive where you'll never own more than 51%.
Right. Wow. And you spoke about that at length during our last episode, where in essence, you're a shareholder of your own insurance company
That's
in
right.
a single parent captive.
Yep. Yep.
Yep.
And that's everything. Ownership isn't just the thing, it's the only thing that any sophisticated employer wants to strive for
Right.
ownership.
Hmm. Okay. So, what kind of financial results do your clients typically see in year one? And then what does year two and three look like? And year five?
So we did a calculation. We looked back 5 or 7 years, I think it was, and on average, we returned about 27 to 30% of the premium back to our clients.
Wow.
Now,
That's huge.
the skeptics out there will say you're just paying more premium and then you're just capturing those underwriting
Right.
profits on the back end. That is remarkably not the case. In
Mhm.
fact, our premiums are generally less than the market. Why are we less? Because we have less SG&A built into the expense of the policy premium, as I
Mhm.
mentioned last time. Our expense load is about 12 to 13 to 14%, somewhere in that area. A group captive is going to have a 35, 40, 45% expense load. So that alone allows us to say, you can pay $1 and get this benefit, or you can pay $1 to get that benefit.
Right.
It's not
Right.
rocket science.
No, it sure isn't. Over 27%. I mean, that's, better
It's
than the
huge.
stock market. It is huge.
Yes.
So, is there a difference between, year one and year five?
Well, I guess my immediate response is I'm pretty confident that every employer is going to have 1 or 2 bad years,
Okay.
5 out of 7 years, right? That's pretty standard.
Right.
So if year one's profitable and year two is that lightning year,
Right.
well, then you may
Okay.
not be profitable that year, but that's
Right.
okay. That over the long haul, that's why I say you give me 5 years, I'll give you hundreds of thousands of dollars in return in your captive.
Yeah, that's great. And of course, the other element is, I would think that as time goes by and the CEO or CFO really kind of gets it and
Mhm.
gets the additional control they have, they would, number one, become more involved in, hey, how come we're paying $131,000 for a hernia repair?
Yes.
How come we're paying 19,800 for an MRI, et cetera? Which they might not have as much real-time access to those kinds of claims with something more traditional.
Yep.
So, therefore, I would think, as you said, a captive makes people smarter, but it probably makes people smarter every year, doesn't it?
It does.
Yeah.
And then what's important is success through intelligence on the health insurance system breeds profitability. And the one thing that I kind of find comical with our single parent model as compared to a group captive model, I will tell you with 100% certainty that when we issue a proposal to you, that proposal was wrong 100% of the time.
Right.
However, when that policy is issued from your captive and it's priced maybe not right, if
Right.
it's priced too high, you are the
Mhm.
direct beneficiary of that
Right.
overpricing.
Right.
So
Yeah.
when the
Yeah.
CFO wraps his or her mind around that and says, "Oh, wait a minute, you mean I could expense $1 here, put that dollar in my captive, and if I don't spend that dollar, I get to keep that?" And the answer is yes.
Mhm.
And then the CFO will say, "No, wait a minute, can I put $2 in there? Or can I put $3 in there?" So the optics change because the
Right.
employer is smarter now
Mhm.
on the financing of employee benefits.
Right.
Yes.
And underwriters and actuaries are conservative by nature. So if they think your claims are going to be $100,000, they will tell you that they think they're
That's
going to be
right.
110, 120 because
That's
they
right.
don't want to be wrong. They'd rather overestimate than under. And if you're with a commercial insurance company, it's to their benefit.
That's right.
If they're with a single parent captive, it's to their own benefit.
That's right.
Wow, that turns the tables. That is a great reason right there.
Yep.
Now, so how can captives help employers to avoid the sort of the boom and bust, the up and down cycles that we see in fully insured plans and sometimes even in self-insured plans with stop loss?
Well, this concept is near and dear to me, and I'm going to throw out a term that's an accounting term near and dear to me. It's earned. The word
Earned.
earned is often abused within this world because there's some propaganda out there with group captives that an employer will join a group captive because they're going to smooth their the renewals. Smoothing to me means, Ralph, you earned a 0% rate increase, but you're going to get a 10. And I earned a 40% rate increase, but I'm only going to get 30. So you're subsidizing me.
Okay.
So the amount of efforts that you're doing to control costs are now diluted down, maybe due to my lack of motivation to control costs.
Right.
So in that model, smoothing of renewals is equivalent to predatory lending within the check advance stuff, right? Remember when employees need cash now, let me advance you this paycheck through short-term lending.
Exactly.
I say that not to be dirty, but employers are seeking control to the runaway healthcare expense.
Yeah.
They're grasping at straws, and the captive is mistreating smoothing of renewals because it's taking one from one and given to the other, and we don't subscribe to that.
Right. So using your one bad year out of 7 theory, if you had, and again, in a perfect world, if you had 7 companies and one captive and each one has a bad year, a different year, then instead of, just being alone where one year you have a bad year and you get a huge increase and so on, it's going to be smoother because there is some sharing.
Well, sure. I mean, if you ask the 6 out of the 7, are you willing to give dollars to someone else today? Likely they're going to say, if I have to, I will, right?
Yeah.
But there's no substitute for actively controlling your risk. And that's what everyone in the risk pool needs to do.
Right.
And there's no way to motivate that than by saying, if you're doing the things that you need to do to control costs, you're going to be the primary beneficiary of that in your own single parent captive. If you're not going to generate any profits in your single parent captive. So you just have to be sensitive on the captives in our risk pool will backstop someone's risk only after that captive has exhausted their own premiums to pay their own claims.
Sure. Yep. Makes sense. Perfect. Yep. Wow. That's great. That's another good reason. I mean, you're just giving just a lot of good reasons, to join a single parent captive that make a lot of sense.
Well, I mean, I'm just not a subscriber to giving to someone else just because they had a bad year. Yeah. Now, here's what I'm going to say. If you have a bad year, if you go out to the commercial market and buy stop loss, the math behind how to calculate that rate is the same way I do it, right? So you can't escape your own risk within stop loss, whether you buy it captive or fully insured or even commercial stop loss.
Yep. That makes sense too. So how should an employer or consultant start? By evaluating whether a captive is right for them, what kind of captive, what question should they be answering? And you talked a little bit about some of them on the last episode. Any more
I think,
feedback?
Yeah, I think the employer has to achieve some level of sophistication to, like I said before, ask the question, why? Why can I not control these claims? And if I can control them, what is the best vehicle to do that? A captive is a good vehicle to do that because it makes you smarter. Okay.
Right.
So the common bond is asking the right questions before you invest in a captive, which we will provide that for you. We are a captive manager. We are the experts. If you have a legal question, you don't go to a paralegal. Who do you go to, Ralph?
A lawyer.
A
And a good one.
That's right. So just be aware that within the world of group captives, there are captive program managers, and then there are captive managers.
Okay. What's the
Captive
difference?
program managers are not necessarily the technicians. They are not the people that run the insurance company. So the captive manager, it is our responsibility to make sure that your captive is solvent and runs according to the regulations in that domicile.
Gotcha. That makes a lot of sense. Okay. So is there any kind of a report they should be asking for that should be made available for them?
Oh my gosh. The bane of my existence is when a group captive does not share the Bordereaux report with their members.
Bordereaux.
Bordereaux. Have you ever
Okay.
heard of a Bordereaux report?
I actually have, but
Okay.
most people
So you got to take the
haven't,
wind out
but-
of my sails. Okay. So,
okay, so let's pretend I haven't.
all right. The Bordereaux report is when the admitted fronting carrier, the insurance company, collects the premiums, and those premiums have to be reported to the captive because the Bordereaux report indicates the top line revenue, that cash in, premium in, all of the expenses, and that leaves a net number. That net number then becomes the top line number of the captive,
Mhm.
and then you have the captive's expenses, and then you have the net. The Bordereaux report is where you see all the expenses. This is where you will discover what's the fronting fee, what's the administrative fee, what's the quota share, what's everything. And you can't invest in a captive until you know those expenses. Because I can tell you right now, not all captives are created equally. Some captives have a higher expense load than others. So you have to be aware of those things.
The Bordereaux report will tell you that?
The Bordereaux report is the missing link to 9 out of your 10 questions that you need to ask.
How do you spell Bordereaux?
Bordeaux. Bordereaux.
With an X?
Yeah.
Or is that just in Louisiana?
Yeah, there's some Louisiana-ish, there's some French-ish in there, yes. Bordereaux.
Right. Okay, cool. So what role do brokers, consultants, advisors play in making a captive work better? And what happens when they're so stuck in their old commission, kickback, override mindsets where they may not understand or want to understand about captives?
So in my world, the consultant is the controller of frequency. Frequency is under the spec. In my world, I'm in the severity world, right? So I only care about, 25% of the spec and anything over the spec. So a good consultant will attack the frequency side of health plan spend. Frequency leads to severity. When you have a broker or a consultant not focusing on the frequency, that's when severity hits. And when severity hits, the client's captive doesn't generate profit. So a good consultant is the first driver of giving their client thousands and thousands of dollars of profit in their captive.
Right. If you had one message for CEO, CFO who feels stuck by their current benefit strategy, what would that be?
Oh boy, just one.
Well, a few.
A few. I could
You
go
can
on and on,
expand,
but I'll limit myself.
How about 3?
So it's all about control. I'm a big fan of control. When you own your own insurance company, you will have levers and control mechanisms that you have never experienced before. I equate it to if you would buy a gas station, you're not going to give your employees half price gas, right? You want to make that gas station profitable.
Sure.
When you own your own captive, you're going to want to make it profitable. So what does it take to do that, right? Because there's real money on the table here.
Right.
Real money. When you own your captive and you're in a risk pool with other captives, the motivation to generate profits is the chlorine that makes the risk pool clean. When you're in a group captive or in a captive that you're not necessarily motivated to generate profits and you're just looking to pay the cheapest premium over and over again, then maybe you shouldn't be in a captive. You should be shopping stop loss every single year.
Sure.
But the misconception that a captive is complicated or a captive is you have to be a jumbo employer to be a participant in the captive, or it takes too much time. It's a time suck. It is not a time suck. We do all of that for you. We do everything from administering your captive to giving you a signature ready tax return. So we take that heavy lift off of your back and you simply hire our firm to be like the general manager of your captive insurance company.
That makes a lot of sense. So when you talked about profitability of the captive, it's profit for you, not the reinsurance carrier.
That's right.
Right? Yeah. Excellent. Okay,
Yep.
great. Excellent.
Because like I'm sorry,
No,
Gordon
please.
Gekko, remember Wall Street? Greed is good.
Yeah. Right.
Right? What's wrong with greed? If you want to achieve a profit, then you have to work for that profit. When you're in a group captive, the harder you work does not necessarily equate to more underwriting profits. When you own your own single parent captive, the harder you work, the more you're going to generate more underwriting profits.
Right.
It's a win-win scenario.
Right. So it changes your mindset, just like
Of course.
when you own a car versus renting
And it
or
should.
a house. Yeah.
And it should.
Absolutely. Absolutely. You're going to, take better care of it.
That's right.
So Phil, we've had a couple of really great sessions, but I'm sure there's some questions that I didn't ask. Is there anything that you think that the listeners should know?
Buyer beware. And I don't want to make that sound like it's bad for captives, but you just need to ask the right questions, because getting into a captive is easy. Getting out of it is not necessarily easy. Certain captives have teeth that make it feel uncomfortable to get out. A lot of times you may leave money on the table. You may have a delay in getting your money back. So you just have to be equally knowledgeable about how to extract as how to get in. And a lot of times that's missed. So just make sure you do your own due diligence, and the consultants out there that are looking for a captive solution that is different, we're that shiny new toy on the market at the moment. And I guarantee that you will have a compelling story to share within the world of single parent captives that direct write the stop loss, as compared to the garden variety group captives that are here, there, and everywhere else in the country.
Wow. Okay. Anything else?
I think we'll keep it at that.
Let me ask you one question. I've heard a lot about capital contributions versus collateral. What does that all mean, and what's the difference?
Oh boy, excuse my French, but collateral sucks. Let me tell you why. So for group reinsurance captives, the admitted carrier has to report on their annual report on Schedule F, and they require some credit risk protection when they work with group captives. So what that means is the employer has to post collateral above and beyond their premium. Now, what's horrible about collateral is it's not a deductible expense.
Okay.
So if the employer has to post $100,000 of collateral, they have to pay income tax on that $100,000.
It's after-tax money.
It's after-tax money. The collateral is not good, and you have to do it every single year.
Every year. You have
Every
to
year.
contribute collateral every single year. Okay.
You got to post it every single year, because the carrier has to post that on their own Schedule F.
Okay.
Within our model, the single parent direct writer model, there's no collateral because there's no carrier, there's no front, but the client has to capitalize it. Now, capital is not a deductible expense either. However, it's your business's basis into your own captive insurance company.
Okay.
So it's like you're buying 1,000 shares of General Electric. You can't deduct that, but you still own 1,000 shares of General Electric. So when you consolidate the balance sheet, the equity, the basis, the capital flows back to your consolidated financial statement. So that 50,000 or 100,000 of capital that you have to pay into your own captive, it's just it's reclassified. It doesn't come, it doesn't go. It's just reclassified.
Okay.
So it's a much better use of cash for an employer to be able to capitalize their captive and not pay collateral.
Right. Wow. So is it fair to say that capital is on your balance sheet, collateral isn't?
That's right. Yes, 100%.
Every CFO is going to know what that means.
Yep.
So big distinction. Great.
Big distinction.
Phil, it has been really a pleasure having you once again.
Yeah,
Thanks for making
thank you.
time, twice in a row. This is good. I think between the two episodes, we've got a lot of information for employers, CEOs, CFOs, CHROs, brokers, consultants, and anybody listening. So I want to thank you so much for your time.
Well, thank you.
And showing employers how to get smarter about their benefits without playing by the carrier's rules.
Well, so I'm passionate and loud about this stuff because there's a lot of stuff out there that needs to be corrected.
That's great. Yes, absolutely. Passion is great. Before we sign off, if people want to learn a little bit more about you, follow you, find out more, How can they reach you or find out a little bit more about what you're
Well,
about?
you can go to our website, our captive management website, which is completecaptive.com. You can look up on LinkedIn. We have our LinkedIn page, Complete Captive on LinkedIn, or even type in my name and I'm sure you'll pick me up somewhere and link up with me. Happy to be your friends with LinkedIn.
Excellent. That sounds great. That's great, Phil. So to everyone listening, overpaying for healthcare isn't just frustrating, it's optional. Captives offer a way out of the rigged game. And if you're willing to ask different questions and demand real transparency, then you can really win with a captive. I'm Ralph Weber, the Benefit Whisperer, and if today's conversation sparked a new idea or gave you something that you can act on, then with a colleague, please share, subscribe, like, and reach out to me at any time at ralph@thebenefitwhisperer.com. And if you go to thebenefitwhisperer.com, you can find past episodes. You can also reach me at 832-924-3330 or visit www.fixmybenefitsnow.com. So let's keep pulling back the curtain because the system won't fix itself. Thanks again, Phil, and I'll see you another time.
Thank you, Ralph.